When the market opens on Monday, April 6th, investors will be forced to confront the fallout of Operation Epic Fury, a military campaign against the Iranian regime that had radically altered the global financial landscape. The closure of the Strait of Hormuz has disrupted the transit of approximately one-fifth of the world's daily oil supplies, sending West Texas Intermediate crude spiking past $111 per barrel. This energy shock is hitting just as the domestic labor market stalls. Friday's employment report showed a massive loss of 92,000 non-farm payrolls, missing the consensus estimate by over 150,000 jobs. This chart shows the stagflationary collision we are witnessing. Inflation is surging due to energy input costs, while the labor market hits a lower structural speed limit. This specific overlap paralyzes the Federal Reserve. They cannot cut interest rates to stimulate the weakening labor market without further fueling the inflation triggered by the Middle Eastern conflict. In this high-rate, high-commodity environment, the buy-a-dip strategies that worked for tech and consumer discretionary portfolios over the last decade are under intense structural pressure. Navigating Monday morning requires ruthless portfolio triage. Holding a misallocated portfolio on the open presents a structural threat to your principal that outweighs any typical opportunity cost. As global munition stockpiles are depleted by regional proxy attacks, the defense industrial base has become a primary safe haven for institutional capital. Lockheed Martin is entering a massive revenue replacement cycle. During recent escalations, Allied forces utilized over 90 THAAD interceptors, roughly 14% of the total U.S. inventory, in just 12 days of combat. To replenish these strategic reserves, the Pentagon has mandated emergency production increases. Lockheed is now targeted to quadruple THAAD production and triple its output of Patriot interceptors. RTX Corporation sits in a similarly insulated position. With a total backlog of $268 billion, the firm has visibility into defense and aerospace demand that remains largely decoupled from standard economic cycles. We are seeing a massive rotation into energy. Capital is fleeing speculative tech and moving toward the high geopolitical premium now baked into crude oil pricing. ExxonMobil is scaling production in the Permian Basin and Guyana to capitalize on $111 oil. This strategy is expected to generate historic levels of free cash flow, even if Middle Eastern infrastructure faces localized disruptions. Defense and energy supermajors currently possess some of the market's most visible revenue backlogs, providing a rare buffer against the broader paralysis of the Fed. The technology sector is diverging. While physical AI hardware is riding a memory supercycle, software-as-a-service companies are struggling under the weight of their own debt. SanDisk is benefiting from a structural shortage in the NAND flash market. With 2026 manufacturing capacity virtually sold out, management now commands the pricing power to drive gross margins into the high 60% range. Broadcom holds a similar dominance in custom silicon. They engineer the bespoke components that serve as cost-efficient alternatives to traditional GPUs for 5 of the world's largest tech conglomerates. But the financing side of tech is fractured. The $3 trillion private credit market is facing a systemic collapse as software companies struggle to service their floating-rate loans. This has created a doom loop. High interest rates force business development companies to mark down the value of their software loans, which triggers panic and massive redemption requests from investors. Blue Owl Capital is at the center of this panic. They recently enacted a 5% redemption cap, trapping billions in requested liquidity. As tech defaults are projected to hit 8%, BDCs mark down net asset values, eroding retail investor trust. Golub Capital exemplifies this deterioration. They recently missed earnings by 34% and slashed their dividend, citing credit stress and a slowdown in new bookings across the software sector. The high yields in private credit are increasingly offset by illiquidity risk. In contrast, hardware providers like Broadcom are supported by sustained infrastructure spending from global hyperscalers. For consumer discretionary firms, the math of a commodity shock is unforgiving. Every dollar increase in crude oil acts as a direct tax on operating margins. Norwegian Cruise Line is caught in this trap. While booking volumes are strong, the company is fully exposed to spot market swings in bunker fuel, which are mathematically destroying their profit potential. While large caps struggle with margins, certain microcaps are utilizing corporate actions to mask their financial distress ahead of Monday's bell. A reverse stock split is a bearish signal. It is a measure of last resort used by companies that have exhausted their ability to raise capital through traditional means. BioAtla is implementing a massive 50-for-1 reverse split on Monday. The move is designed solely to force its share price above the $1 minimum to avoid delisting from the Nasdaq. Mobex Labs is executing a 1-for-10 consolidation. The firm is currently burning through cash at an unsustainable rate and holds a dangerous current ratio of just 0.11. Holding unhedged consumer stocks during a fuel spike or microcaps during a forced split historically exposes retail investors to the exact mathematical friction that professional short sellers use to find liquid exits. The triage matrix identifies your path forward. Monday's allocation must be dictated by asset-specific data rather than general market sentiment. For the defensive capital preserver, the directive is clear. Move away from consumer discretionary and overweight the tangible growth of defense and energy. For those in private credit vehicles like Blue Owl or Galoob, the priority is evaluating an exit before liquidity windows potentially tighten even further. For the active, event-driven trader, the artificial price bumps in BioAtla and Mobex Labs represent prime entries for short selling once the post-split selling pressure begins. Finally, avoid SWK holdings entirely on Monday. The stock is scheduled for a pre-market merger halt, meaning your capital will be trapped and illiquid during the session. Surviving the 2026 stagflation economy requires looking past the nostalgia of the zero interest rate era. Success on Monday requires cold, clinical, and mathematical triage.